You just sold your vacation house for $500,000 and the money's sitting in your checking account, making nothing. And like everyone else, you hate paying taxes. You're a conservative investor and you're thinking about putting the money in a CD. You're driving through town and you go by your local bank, and out on their sign in big letters it says CD special, 12 months at 4% interest. You're thinking about doing the CD, but you're wondering, is there a better way? I help clients answer questions like this all the time. Hi, I'm Trevor Johnson, founder of Dreamweaver Financial Planning. I help hardworking families that are nearing retirement or in retirement turn their savings into financial freedom. There's 3 assumptions I'm going to make when I answer this question. The first assumption is the $500,000 is in a taxable account. If the money was in a Roth IRA or a traditional IRA, the information in this video would be different. So again, we're going to assume they sold a vacation home and the money is now sitting in a taxable account. The second assumption we're going to make is that in this situation, the investor is very conservative and they do not like the ups and downs of the stock market. And the third and final assumption we're going to make is that this particular person has paid a lot of income taxes throughout their career, and they're currently paying a lot of income taxes in retirement. They have a healthy Social Security benefit, they have a pension, and they have a lot of taxable interest income, and they are sick of paying high taxes. First, let's analyze the CD. $500,000 at 4% interest in 1 year would generate about $20,000 of interest income. CD interest is taxable at both the state and federal level. In this example, we're going to assume the client lives in a state that has no income tax, such as Florida, to keep the example simple. So they take out the CD, 1 year's up, they have $20,000 of interest income, but they're in the 24% federal tax bracket. So they are left with $15,200 of after-tax interest income that was generated by their 1-year CD. So is there an option out there that might be a better fit for this person? Let's talk about a municipal bond fund. A municipal bond fund is a basket of bonds, in many cases hundreds if not thousands of bonds, that have been issued by local municipalities from throughout the country. The great thing about municipal bonds is that they are free from federal tax. Let's say that there's a municipal bond fund that's generating 4% interest. Your $500,000 would generate about $20,000 of interest income in a year. So in this example, the $20,000 of interest would be tax-free. Remember, there's no federal tax on municipal bonds, and this client lives in a state where there is no state income tax. So the client would keep the entire $20,000 of interest income. That's $4,800 more dollars than if they had done the CD. Let me teach you a simple way to compare these options. First, we need to get the rates on an apples-to-apples basis. Remember, the CD was paying 4% interest per year. Now we need to convert the municipal bond interest rate to its taxable equivalent rate. So we just take the interest rate on the municipal bond fund, in this case 4%, and we divide that by 1 minus your federal tax bracket. So 4% divided by 0.76 equals 5.33%. So in other words, you would need to find a taxable CD that was making over 5.33% to beat the municipal bond fund in this case. There are 2 important things that you need to know about municipal bonds before you invest in them. When buying municipal bonds, you expose yourself to interest rate risk. This means the value of your bonds will rise and fall based on changes in interest rates from the date that you purchased the bonds. Think of it this way: if you buy a bond at 4% and then interest rates rise to 5%, your bond isn't worth as much anymore because an investor can buy a new bond at 5%. So if they wanted to buy your bond at 4%, they would pay you less than what you paid for it. Now the opposite is also true. If you buy a bond at 4% and then interest rates fall, let's say they fall to 3%, then the value of your bond goes up because you're locked in at 4%, but an investor that wants to buy your bond, the best he can get with a new bond is 3%. So he'd be willing to pay you more for your bonds. In our example here, we're assuming that the investor just buys the bonds and holds them and either lives off the interest income that the bonds generate, or they reinvest the interest income. If the investor were to sell their bonds, there would most likely be a capital gain or a capital loss that would need to be reflected on their tax return. What this means for the investor is if there was a capital gain, then they would owe taxes on the capital gain. And if there was a capital loss, then they would get to write part of that off on their tax return and save some on their taxes. Here's a bonus tip for staying to the end. But first, please remember to like and subscribe to the channel. And if there's a finance video you'd like me to make in the future, please leave it in the comments below. Since we were talking about CDs earlier in the video, one of the most common misconceptions that I see is people will see a CD special advertised that's less than 1 year. So for example, they'll see a CD special that says something like 6-month CD at 4% interest. And what the majority of people think when they see that is, if I put my money in that CD for 6 months, I will make a full 4% on my money. Now, the thing that you have to realize here is that banks quote CDs on an annualized basis. So in this case, your money is only in that CD for half the year. So you'll only receive about half the rate. So if you did the 6 month CD at 4%, you'd only make about 2% on your money in total. Thanks for watching, and I'll see you next time.